For decades, the 4% rule has been treated as the gospel of retirement income. You retire, you withdraw 4% of your savings the first year, adjust for inflation each year after that, and you're supposedly safe for 30 years. The problem is, the rule was built for a different era, and applying it blindly today could either leave you broke or leave you sitting on a fortune you never spent. Here's what retirees are actually doing instead. The 4% rule came from a study done by a financial planner named William Bengen back in 1994. He looked at historical market returns and asked a simple question. How much could a retiree withdraw from their portfolio each year without running out of money over a 30-year retirement? His answer was 4% of the initial portfolio value, adjusted for inflation each year. The study showed that this withdrawal rate would have survived even the worst 30-year periods in U.S. market history. It was a useful starting point. For 30 years, it shaped how people thought about retirement income. But the 4% rule has problems, and in 2026, those problems are bigger than ever. Bengen's analysis used data from 1926 through 1976. That period included strong long-term returns from both stocks and bonds. Bond yields in particular were much higher historically than they are today. A retiree in 1980 could easily get 6 or 7% yields on government bonds. That made a 60-40 portfolio of stocks and bonds produce solid returns with relatively low risk. Today, bond yields are lower. A traditional 60-40 portfolio is expected to produce lower returns going forward than it did historically. Several major financial firms have published research arguing that a sustainable withdrawal rate today might be closer to 3% or 3.5% rather than 4%. The 4% rule says you withdraw the same inflation-adjusted amount every year, regardless of what's happening in the markets or in your life. That's not how real retirees actually behave. When markets crash, smart retirees cut back. When markets boom, they might spend more. When they have unexpected expenses, they adjust. The rigidity of the 4% rule makes it both too conservative in good years and too aggressive in bad years. The 4% rule assumes you need the same inflation-adjusted income every year of retirement. Research shows that's not how retirees actually spend. Many retirees spend more in their early 60s and 70s, what's sometimes called the go-go years. They travel, they pursue hobbies, they help their kids, they enjoy their freedom while their health allows it. Then spending often declines in their late 70s and into their 80s, the slow-go years. Travel decreases, activities slow down, spending drops, sometimes significantly. Then in their late 80s and 90s, spending may rise again due to healthcare and long-term care costs, the no-go years. This three-stage spending pattern doesn't fit a flat withdrawal rule. Smart retirement planning accounts for it. The 4% rule treats your portfolio as one undifferentiated pool of money. But in reality, retirees have different account types: traditional accounts, Roth accounts, taxable brokerage accounts, that are taxed completely differently. Which account you withdraw from in which year can dramatically affect your lifetime tax bill. A simple 4% rule doesn't address this at all. So what are retirees actually doing instead? A few alternative approaches have emerged as smarter ways to think about retirement income. First, instead of a fixed inflation-adjusted withdrawal, dynamic withdrawal adjusts based on portfolio performance. In good market years, you can take a bit more. In bad market years, you cut back. Some versions use simple rules. For example, never increase your withdrawal in a year your portfolio declined, or limit increases to inflation if your portfolio gained less than 4%. The benefit is that this strategy can support higher average withdrawal rates because it builds in protection against bad sequences of returns. The downside is that you have to be psychologically prepared to actually cut spending in bad years. Many people aren't. Second is the bucket strategy. This approach divides your retirement savings into 3 or more buckets based on time horizon. Bucket 1. Cash and short-term reserves covering 1 to 3 years of expenses. This is what you spend from. It doesn't fluctuate with markets. Bucket 2. Conservative investments covering years 4 through 10, mostly bonds and bond-like investments. Lower returns but stable. Bucket 3. Growth investments for the long term. Stocks and equity-like investments. Higher expected returns but volatile. As you spend down bucket 1, you periodically refill it from bucket 2. As you spend down bucket 2, you refill it from bucket 3. The benefit is that you're never forced to sell stocks during a bear market to fund living expenses. Your spending money is in stable assets. Your growth assets have time to ride out volatility. This strategy doesn't have a single withdrawal rate. It has a structure. Third approach is the guardrails strategy. This is a variation on dynamic withdrawal that uses specific triggers. You set a starting withdrawal rate, say 5% of your initial portfolio value. Then you set guardrails. If your portfolio value drops below a certain threshold, you cut your withdrawal by 10 or 20%. If your portfolio value rises above a certain threshold, you can increase your withdrawal. Research suggests that with reasonable guardrails, retirees can often start with a higher initial withdrawal rate than the 4% rule suggests, sometimes 5 or even 5.5%, and still maintain high success rates over 30 years. The trade-off is that you have to accept some variability in your spending year to year. Approach 4. The income floor approach. This strategy splits retirement income into two pieces. The first piece is a guaranteed income floor, enough to cover your essential expenses for life. This typically comes from Social Security, pensions, and sometimes annuities purchased specifically to provide guaranteed income. The second piece is your investment portfolio, which you spend more flexibly to cover discretionary expenses and lifestyle. The benefit is psychological. You know your basic needs are covered no matter what happens in the markets. That allows you to invest the rest of your money more aggressively and spend it more freely. The trade-off is that locking up money in annuities reduces flexibility and removes potential upside. Here's the bottom line. The 4% rule was a useful idea for its time, but it's no longer state-of-the-art thinking. Modern retirement planning is more flexible, more personalized, and more attentive to taxes and timing. That doesn't mean 4% is wrong. For a very simple, very conservative approach, withdrawing around 4% of your portfolio annually adjusted for inflation is still a reasonable starting point. But you can probably do better. With the right strategy, you can either spend more in retirement, leave more behind, or build in more protection against bad outcomes, sometimes all three. The biggest mistake retirees make isn't withdrawing too much or too little. It's not thinking about this at all. Plenty of people retire without any withdrawal strategy. They just start pulling money out as they need it, without considering taxes, account types, market conditions, or future needs. Then they either run out of money sooner than they should, or they hoard money and miss the retirement they planned for. You don't need a perfect strategy, you just need a strategy. Any of the approaches above is better than no plan at all. Here's what I wish more retirees understood about withdrawal rates. The 4% rule isn't a law of nature. It's a research finding from 30 years ago that's been treated like commandment ever since. The real goal isn't to find the magic number. It's to build a thoughtful, flexible approach that adjusts to your life and the market conditions you actually encounter. That's what real retirement planning looks like in 2026. If this changed how you think about retirement income, hit that like button and drop a comment below. What withdrawal strategy are you using or considering? I read every comment and I love hearing how people are approaching this. And if you want more content that breaks down outdated financial rules of thumb, subscribe. I share exactly what I wish I knew so you can make smarter money moves.